welcome to our Counsel Tech Podcast, in which we discuss law firms, what do they do best, and what they're good at, and how we at Think Innovation we can help with them. So why don't you go introduce yourself as a high level, explain your role in the business, and let's start with your company and what you do with on every day.
Sure thing. Hi, and thank you so much for having me. My name is Lindsey Mignano. I'm one of the co-founders of SSM, which is a women-owned boutique corporate law firm here in the United States. We have attorneys in Los Angeles, San Francisco, San Diego, and Seattle. Our primary practice areas are venture capital, mergers, acquisitions, commercial transactions. My particular practice area involves venture capital, but also flipping foreign companies for venture capital financing events in the United States. Thanks so much for having me.
Well, it's a pleasure to have you. And what you do, it sounds really, really exciting. So why don't you explain to us what is venture capitalist as an introduction? What is a venture capitalist, and what does it make sense to start approaching venture capitalist firms for investments?
Yeah, so most of our clients are anywhere from seed stage startups to Series B stage startups here in the US. Some of them are foreign and they're coming here to flip and finance. Others of them are American companies born and raised here who are financing. For the most part, venture capital can be a very large term that comprises a number of people. At the very, very early stage at pre-seed or angel, family, and friends round, it could include angel syndicates, angel investors themselves, pre-seed VCs who cut smaller checks. Same thing for seed. When we get to Series A, it could include venture firms that are either vertical or stage agnostic, but also venture firms that are very specific to seed stage investing. It could include some CVC or corporate venture capital, which is where, for example, maybe Intel has a venture capital arm of their company and they devote Intel's money and some other LP's money to invest in a variety of different types of startups that they may or may not want to acquire someday. And that is usually at the priced round stage. It can go all the way up, the chain to IPO. Generally in the US, and I know these numbers are very different from other countries and other places, but here in San Francisco, California, we're seeing pre-seed anywhere from 500,000 to $1 million, and that's usually on a Y Combinator safe note. At this point in the game, that's the most common instrument here in the coasts. And then we're seeing seeds from 1 to 5 million, with a sweet spot of 3 to 5 is when we start to see a shift towards a series seed, which is a priced round. Then, of course, we see Series A beginning at about 10 million. It can be certainly higher. It can be certainly lower. It's industry specific, but I would say 10 million is a good marker. 10 million minimum coming in the door. It's a Series A, usually NVCA standard document priced round. Series B, beginning at 20, C beginning at 30. It can go up the chain as such. Of course, these are like very industry specific numbers. So for example, if you're in deep tech AI, your pre-seed is not going to necessarily be 500 to $1 million. We have a client who just raised a 4.4 million pre-seed round on safe notes, right? So certain industries like life sciences or deep tech, robotics, things that are very capital intensive, are obviously not going to be at these numbers, but of course, I'm just giving you the broad lay of the land as to where venture capital rounds lie and who the players are.
Well, that's really interesting, and I believe right now with new tech is coming into the market, there's always new startups showing up. So what does it take for a startup to raise its first priced round these days?
And it's different for different stages, right? So and I'll just back up for the pre-seed and seed folks. You are going to have less to show at that stage in order to get to where you need to be at the next stage when you do raise your price round. But at least at the pre-seed and seed, we usually have a founding team, maybe 1 to 3 people. Usually it's 2 to 3 statistically and anecdotally that we see raise venture capital financing. There's usually some early traction and a lot of debate around this. There are some pre-seed VCs who will say, hey, I don't demand any annual recurring revenue if you're an enterprise SaaS or PaaS AI company. Others will say, I do absolutely demand it. And if you're raising a 3 million series seed, I'd like to see 1 million in the door every year, right? So it just depends on the VC, but sometimes there is traction, and that's usually validated by like a beta or a pilot trial that's being converted into an annual paid subscription. So we're seeing that the companies who are successfully raising at the pre-seed or seed already have some traction, or at least indication of traction or potential traction. When we have the companies that are going from seed to A, that number for annual recurring revenue does become a little more important. And if we're raising a 10 million Series A minimum, we have VCs who would request of our clients to usually have, 2 to 4 million in annual recurring revenue for their enterprise, with a sweet spot at 2 to 3, honestly. We normally have those clients who have that in the door, usually being successful in raising a 10 plus million Series A. It is at that point in the company's life cycle where it's not just founder-led sales, although founders absolutely can dictate the sales process, but there's usually some sort of repeatable, scalable model beyond just this one guy and his connections that are able to scale enterprise level software. And, normally at that point, the company has a better idea of, how it fits in the marketplace, the product stickiness, whether or not they're able to command more than just this one department at a big tech or big company, but like scale it organization wide, right? There's usually some sort of clear milestones as far as like what our go-to-market is and what the next things we need to do to in order to get to our next, hopeful valuation. And that usually requires money. So when they're going for Series A, you're seeing demonstrated marked milestones in their deck where they're saying, we're going to take this money, we're going to put it to this thing. And then after that, 3 months later, we're gonna use that revenue and that financing to do this thing. And there's much more of a credible, coherent business plan. At Series B, and I'll stop at Series B because we could certainly go all the way up the chain. But most of our clients are, I would say, seed through Series B. So at Series B, it's a little bit more sophisticated than Series A. You definitely have a better financial pipeline. You have repeatable sales. You have somewhat predictable growth. There's less churn in terms of the way that customers may come and go from your company. We have more prediction around what kind of churn we can expect, what kind of loss we can expect, loss of customers. So there's stronger unit economics. And I would say at this point, we have pretty good sense of leadership in the company. So maybe the founders are still there, maybe they're not. Maybe one dropped out. Maybe there was, a founder fallout, which happens often in early stage. But at this point in the game, when we're approaching Series B, we have a very solid leadership team that can sell itself, right? So I think that those are the leadership team, the revenue, the unit economics, the 3 items that I really think most of our clients who are approaching Series B are have in place before that they actually go to VC for that.
It's intake, because it's interesting, because when you look at the intake process from your side as a law firm, when you're getting in a new client, you need to analyze their whole business model, right? Where what's their product? Is it an MVP? What's their future roadmap is looking like? And when you look at the business models, there are the building blocks. Where's the client? How do you reach out to the client? What problem you're saving, the pain points and such? Is it something that you do as well? Like, you, before pitching it to investment firms, do you analyze their own business model to understand where they stand at right now? And do you sometimes advise against going for funding at that point?
Venture capital funding is the most expensive kind of funding you can ever get, right? It's dilutive, right? So we always try to make sure that they're in the right mindset if they want to go down that path, that they understand the implications and the loss of control and the dilution that can happen, right? So because, statistically, you can see dilution at like 20% at seed, maybe 16 to 20% at Series A, 16 or less at Series B and C. So you are losing equity, which is money if you're a founder, right? So you are also losing control. And I think, we have a lot of people in Silicon Valley. I live and work in San Francisco who are very much of the ilk that, venture capital is a badge of honor and that they can tell their friends that they are venture funded. And sometimes that comes with the naivety of not really understanding what those bells and whistles, are when you take in the money. So talking with them about that and informing them and asking them, hey, are you the kind of founder that, wants to make this company scale and be a unicorn? Are you the kind of founder who wants to build something and then maybe sell it at Series A or Series B? And maybe venture capital all the way up the chain is not really what you need, right? So we definitely have those conversations, and all good corporate lawyers actually do have those conversations very early in advance. there is some, expectation, I think, in Silicon Valley that the startups are more sophisticated than other parts of the world because they're surrounded by it. So they know a guy who's taken venture capital and exited, or maybe their spouse has, or maybe their best friend from college did, because there's so much here with Stanford and Cal and just being in the Bay Area that you can't like swing a purse over your shoulder without hitting someone who hasn't received venture capital. So they are somewhat educated, but we do talk with them about that. We talk with them about their business model. We talk with them about the current market. Right now, for example, any round 5 million or less, that's down currently, right? So in the past couple of years, it's been seed and Series A companies that have taken the hit, both in terms of like the dollars deployed and the number of deals that they provided, that venture has deployed. And so as a result, having our companies that are earlier stage, understand the market, understand where they fit in the market, understand what their weak points are when they go to VC, but what their strengths are when they go to VC is really important. We certainly do talk with them about that before they even get to VC.
I think these conversations are really important because I've met people who always discuss they want to be angel investors, investing through them, and I'm telling them, look, you never know what type of headaches you're gonna get with an angel investor and the amount of control you're gonna lose sometimes. So it's really important to put them in the right state of business mindset before they approach the VCs. And you speak a lot about Silicon Valley and the investments that going there, and I think someone with a purse who has back up through VCs. Uh, Today, in general, in this market, lots of AI, lots of hot talk about AI. And what do you think? What do you see? Uh, where the investments are going through which directions in general? Like, how's the market shifting?
Well, at least in the US, and I can't speak for Canada, but in the past few years, different sources will tell you different things, but anywhere from 30 to 40% of venture dollars went to AI companies, right? So the first iteration was generative, and now we're seeing the second iteration of investments into what I would call agentic AI. That's the new hot girl at prom, as the saying goes, right? Everyone's in a kind of really interested in agents. I would say even with early stage deal count and deal dollar deployment down in the US, so seed and Series A not being as big rounds or not being as deployed to rather than the later stage companies, right? VCs are being pickier about that. So even with that, if you are an AI company in a hot vertical, and hot verticals can be anything that the government's prioritizing right now. So that tends to be, defense tech, fintech with AI, crypto companies, hard tech, which is something that people realize like, what's hard tech? But hard tech is anything that's like somewhat hardware focused or really capital intensive AI companies, right? Those are really hot verticals. And if you look at the stats, there are quite amount of venture dollars going to those companies at the early stage, despite the round sizes and the deployment being down for those early stage startups kind of just more agnostically, right? If you look at AI as a sector, they are doing really well at the early stage. So I would say, that's the bright spot. AI companies are doing great for that, especially in the Bay Area. AI enterprise SaaS or PaaS, those are very big umbrellas. They could encompass all of the things that I just mentioned, right? But those are doing well. And most of the companies that come to SSM are, at this point in the game, AI enterprise SaaS or PaaS. They can also be AI-enabled health tech enterprise software or AI-enabled clean tech, targeting government contracts. But there is always an AI component these days. And it's been that way for a few years, where we've seen the most successful companies raise are the ones that are using some sort of proprietary, not just a wrapper, but proprietary AI. And then, of course, late stage companies are doing great. So if you look at venture dollars deployment, like all the big ones, OpenAI, Anthropic, these are raising massive, massive rounds, right? So larger AI deals are really the predominant bulk of the venture capital deployment today. And that has been the case for last year as well. So you're seeing a little bit more of a crunch at the early stage, but in the late stage, we're seeing quite a bit of deployment and good valuations in that.
Yeah, the AI space is definitely something very hot spot. Everybody's talking in, lots of funding coming in from governments, private sectors, VCs. So, as a lawyer, that's somewhere I would like to be as well because that's what I would like to follow. And so these businesses that are approaching venture capitals, like what metrics should a founder have in place before approaching a VC firm? Like they obviously the first point of contact is they approach you and you start to guide them. But from your side, what metrics do you look at first thing first?
Yeah, I would say the annual recurring revenue debate at the early stage is really interesting to me right now, with some very, very early VCs saying they don't require it at all, and some similarly situated early stage VCs saying that they absolutely require it. I think that at the earliest of the early stages, so pre-seed, seed, and I define pre-seed anywhere from like say 500,000 to a million, seed maybe like 1 to 5 million. That it can go either way. Like they can have that or they cannot have it. And depending on who the VC is and what the requirements are, they might be able to get away with not having it, right? They could just have great pilots out with really big enterprises and signs and customer validation that it's probably going to convert into a paid subscription, and that's enough. I think at Series A, the requirements get quite tougher, right? So we're really looking for ARR now, and again, we've seen 2 to 4 million with a sweet spot at 2 to 3, depending on the type of enterprise SaaS or PaaS. It could be even more than that. Some VCs will say, I don't even get involved unless they have like a 3 million ARR
Mhm.
on their books, and that's demonstrated both on the books and in the legal documents, right? So we want to see that. We want to see consistency in the growth metrics 2 to 3 times a year over year. We want to see really strong unit economics. And then we want to talk with some customers, especially the big enterprise ones that are strong, and see how we're retaining that revenue, how we're making sure that we don't have like a super high churn rate. Like, what are you doing to keep your customers happy? I think also at this stage, when you're going for Series A, there is an emphasis on scalable sales. And we've done some presentations with other people who literally just do go to market and sales. All they do is help startups do partnerships and then cut their churn, right? So that's their entire business line. It's always very well attended because at that point, when you're seed going to Series A, one of the things that they want to see is that like repeatability, right? So if we're taking something that's just a founder-led sale initially, but we're scaling it, we're making it sticky, and it means that it's not just this one guy with his one connections who's really striking the deals, but it can actually be repeatable by a VP of sales or a sales team even, and that there's a clear pipeline coming in the door. And then of course, financially, we love to see runway. Recently, in the past few years, or at least in the past, before the past through few years, we would see maybe 2 years between rounds. So like they would raise a seed, maybe see 3 million, and they would wait a couple years, 18 months, 24 months, and they would raise their Series A. And now we're seeing companies who are on like year 3 of not raising their next round, right? So it can be now 24 to 36 months, not 18 to 24 months. So that runway has to be sustainable. And because there are more time between, priced rounds at Series Seed or Seed going to Series A, having the startup connect with its CFO and really understanding like, hey, it could be that you raise this Series A now, but maybe not in the typical 18 to 24 months will you raise your Series B. Do we have enough in what we're raising to make it there, right? What do we have enough to like really like forecast that runway and make sure that we're going to be okay? And are there other types of capital that we can consider looking at? For example, non-dilutive capital or dilutive capital. Like at Series A, we see people look into venture debt. Venture debt is something that's very controversial. Like some VCs love it and see it as a part of the ecosystem. And of course, we would extend our runway for the company by opening up that line of credit. Other VCs that I've talked to are absolutely not. They will not allow the startup to take venture debt. It is a hard no. Venture debt is very nuanced. Venture capital is very nuanced. The decision, it can be expensive to the startup in both ways, but that is something that we usually see considered at the Series A round. And then of course, Series B, kind of the same things, but just at an elevated level. For the most part, I will say this can be even more varied depending on the type of vertical of the startup. So while all things are varied with the vertical, I think with our Series B clients, the metrics are different based on what kind of startup they are.
Oh, yeah, it's really insightful. Thank you so much for all of this insight. Now I know we're almost October time, so what do you predict regarding the remainder of 2025 of the venture market, of course?
So one thing that we haven't talked about enough, I think, in the past few years is the rise of secondaries. So secondaries are super interesting, and secondaries have become so prevalent before the IPO market picked up in 2025. So in 2021, we had a really banner year for financing. Everyone was getting, money, and there's a little bit of, throw spaghetti at a wall effect, where some of the clients that we were seeing get 3 million, 5 million, maybe they were repeat founders, but they hadn't even formed their legal entity yet for their company. It was just, money was just being deployed almost in a FOMO fashion. And then we had to pull back from that, right? So we had a time where we weren't going to see as much financing go out the door. We weren't going to see as many IPOs. There were no SPACs, in the later years. And the reaction to that was really interesting. So as a result, right, employees and founders were not necessarily getting liquid through IPOs, and their investors weren't getting their money back to LPs as quickly because of lack of IPOs or at all, right? And so there became this push for secondaries, and a lot of the bigger later stage companies started offering tenders like once or twice a year, which is fantastic for employees, where the employees could sell back, some of their vested shares. Options turned into vested shares that they exercised. They could sell it back to the company, get liquid. Founders could, after the next round, agree to sell some of their common shares that they had already vested, and that was great because maybe that guy needed to pay for his kids' college or put a mortgage down. Just things that they were, waiting for. That was wonderful, I think, for the founders and for the early stage startups and startup employees. And then, of course, investors might want to use their block to sell to other investors who are coming in, or usually not back to the company, but in some way trading so that they could get some liquidity back to their LPs. What I think is really interesting that has happened as a reaction to that is that we have seen some startups raise from VCs today. So this is now after 4 years of not such great IPO climate after 2021. So like 2021, yes, excellent banner year. 2022, 2023, 2024, and now 2025, we're seeing that IPO market pick up again. But between then, those 3 years, we were seeing some VCs make really smart moves because, they were requesting that, you remove certain provisions from founder stock agreements, like double trigger acceleration, which is a really helpful one for founders.
Yeah.
It means that when you, get acquired, all your shares vest, regardless of whether you vested them in time, right? They were also requiring, we had a VC who actually asked during the price round raise to say that there would be a blanket restriction on secondary transactions for all founders and early stage hires in their stock agreements and in the bylaws, with the exception carve out for preferred shares that investors own that became common. So that allowed the VCs to have secondaries, but not the founders and early stage hires. So there is reaction from the market and from the VC community because the tenders are such a crazy and expensive process. We've seen so much of it. Limiting the tenders on the VCs, limiting the tenders on the founder and early stage employee side was a reaction to that, to control the cap table of the company, right? So we have seen that anecdotally. I don't think that's been wide scale. I do know that was something that happened in deals that we've seen. I wonder whether other firms have seen it too, or whether firms who represent venture capital firms are routinely requiring it. And then, of course, I do think there's going to be a lot of AI team acquisitions. I think big tech, we had a lot of AI companies that were funded in 2021. We have a lot of companies that are being funded even today, 30 or 40% in the early stage startup portfolio that are funded are AI companies, right? It's some of the stats we'll say out there. And I know that's a big range, but 30 to 40%, even just that block from various sources means quite a bit of startups. Like 1/3 of every funded startup is an AI early stage company when we look at the early stage block. So when we think about that, projecting that down the line, I think there will be a lot of acquisitions of the ones that may not make it from seed to Series A to Series B. And it makes sense because big tech or later stage AI companies, it's cheaper for them to acquire an asset or a group of people from an already somewhat built out, funded Series seed AI company rather than go headhunt for that talent or go head, and try to build that technology. It's just cheaper and faster. So I do think that's going to be a way that bigger tech, and I call big tech like later stage companies, public companies, use to stay competitive with each other. So I do think AI acquisitions are going to be a really interesting part of the market and offer some liquidity to both founders and VCs.
Oh, well, that's really interesting. The way you frame it, the outlook for 2025, the whole VC market, it's really interesting, and it needs a lot of research to stay ahead of the curve and to predict how it's gonna move forward. So, what would your piece of advice be for startups that's looking to be part of a VC or being acquired by a VC?
Yeah. So, one of the things that our firm does, and I think a lot of law firms do this, so it's not a unique a strategy, but we throw a lot of events with VCs. So for this SF Tech Week, we are throwing 4 lunch events with anywhere from 2 to 4 VCs on the panel, talking about the current climate, educating the group about what they're looking for, what kind of things that they're funding, why they're funding certain startups, why they're not funding others, right? I think these sorts of conversations are pivotal. They're business conversations, but I think they're pivotal for founders to understand the market and where they sit in relation to it in this economy, right? So I think one of the best things founders can do is certainly educate themselves about it. Education is one of the things, information and education is one of the things that SSM, I think, does really well in terms of bringing VCs in front of early stage startups and making sure that they understand what the ecosystem is saying. Aside from, events, which are great ways to meet VCs, great ways to hear from them, I tell all of my clients to review quarterly reports, PitchBook, CB Insights, Carta data, all the cap table software data actually should be out there. There's a lot of senior analysts and analysts out there at a variety of cap table softwares, AngelList, Pulley, all of them. And they're crunching data because they have all these startups on their platform. I like to tell startup founders to actually review that data to make sure that when you are raising your round, you're, making sure if you're raising a seed round that you're raising at the right post-money valuation cap on that safe, and that it's not being too low as to be further dilutive in the stat, right? There's so much information out there, and I think that startup founders who are really serious about taking VC money are the ones who are actively reviewing the quarterly reports, actively going to the events, actively having conversations with their law firm and their CPA firm, and understanding how things come into play when they're raising money, especially dilution.
Yeah, that's for sure. The only question that comes to my mind is that when you sit across the table from a founder, you have a business founder and you have a technical founder, right? And maybe it's at one point everybody wants to go in a certain direction. How do you reconcile different point of views?
Yeah, a large sweep. We normally have 2 or 3. In fact, statistically, they're always guys. So we normally have 2 or 3 men on a call with me discussing, go-to-market strategy, but also the ins and outs of financing. And some people really understand, right? Like at the early stage, they understand the market. They understand how those Y Combinator post-money safe notes convert. They understand, what the Series Seed or Series A means for their dilution. They've run the pro forma. They've done the homework. And other times, like one person on the team has done it, but the others have not, right? So a lot of it, or one person understands it, but the others do not, right? So a lot of times it's working with that dynamic of catching up the people who need to be caught up in the room so that everyone's coming in at least at the 101 level. And I think that is the part that AI in legal tech is so great, and it's allowed law firms to do a lot of things. One thing that I cannot outsource to AI, I know this because I'm on calls all the time, is the back and forth with clients about like, hey, I know you read this on ChatGPT. It's actually correct. Do you understand it? and let me make it dumbed down for you so that you get it as someone who's not operating in like corporate law on a daily basis. Let me explain to you the TLDR watered down version of what this big article says so that you can grasp it intellectually, which is hard. It is hard. I think really good lawyers, and there are tons out there, are able to take something that's very esoteric and very difficult and make it sound relatively elementary, like explain it to a 9-year-old. And to the extent that you can do that, I think as a lawyer, then I think you have really good job protection, because I think there's not enough of those lawyers out there.
Yeah, I've worked with tech people, I've worked with the legal people, and every time I'm in the impasse, I ask ChatGPT or whatever AI tool to explain it to me like a 5-year-old, not even a 9-year-old, to go to think it's simpler and simpler and simpler. One thing I learned is that it's a good advice to anyone listening to us. Don't take any advice from ChatGPT at face value. You always do have to do your own research. Otherwise, these LLMs, they're made to babble, and they'll speak out whatever information they think it's relevant to the conversation, while it might not be the case. So my advice to startups is make sure that your business model is correct. As my understanding from this conversation, make sure your business model is correct. Make sure you know where your clients is, where your finance is coming from, what's your pain point you're solving. I can help you solve those, by the way. And go talk to Linda at SSC, because she knows a lot about venture capital. And I think before my take would be always make sure all points of view are aligned. Everyone is in the same place, same state of mind where they want the future of their company to go to before going VC or going to an IPO. That would be my piece of advice to you. I'm not sure if you would like to add anything to that, Linda.
Yeah, and I'd love to emphasize, not every company is made for VC. A lot of the companies that come to us really want to be VC funded. It's expensive capital. I think there is a realization that happens maybe a year or two down the line that maybe this company, while a successful company, is really just more of a really successful to-be small business, right?
Yeah.
And there are tons of those out there who have never taken venture capital, but maybe it's not the kind of company that a VC would want to fund, because it's not going to be a 3 to 5x for those that VCs, LP returns, right? They're not going to be able to, ever be a unicorn. The size of the market, if we look at the size of the market and the sliver of the market that VC funded company could even take is just really not there. The metrics aren't there. And I think that's a hard realization for a startup founder to come to like a year or two later after anchoring. Anchoring is like a business school term, but anchoring to that reality of like, I want to be a venture capital funded company. So I encourage startups to like really think about this strategically at the get-go, because there's a lot of things that lawyers can do to make you a venture funded company that would be somewhat overkill if you're really a small business that's privately owned and maybe a little angel funded, and you have a desire to sell in 5 years after your QSBS deadline is up, right? That's the amount of legal work that we may apply to that could be less, and your bills could be lower because of the less scrutiny that's involved in terms of oversight by venture capital lawyers looking through your books and your records and doing your rounds. And so I think that's something for startup founders to really be mindful of at the get-go.
Oh, well, thank you. Thank you, Lindsay from SSM. I really appreciate your input, and it's very helpful. On that note, I think we're going to thank you for being on our podcast today, Counsel and Tech. This was very enlightening, and I hope all our viewers are going to make the best out of it.
Yeah.
Thank you, and we'll stay in touch.
Okay.